Hello and welcome to the channel. In this video, I'm going to show how I manage stop losses for positions that I own. This is a key concept for portfolio risk management. After publishing a video on April the 11th about the SPX price action during the tariff implementation, I was asked a question in an investment-focused Discord group. Brian asked, "So are you attempting to time the market or just doing this for awareness, learning, and fun?" And I replied in the Discord group, "I like to monitor trends to help with establishing my expectations. I do use individual company charts to determine when I should trim or add to a position. I like to blend the technical with fundamental analysis. I don't rely exclusively with one approach over the other." I also replied, "I have several examples where I hold a core position, then trim and add when the chart supports that action. These have resulted in some of my holdings returning my entire investment, so now that I play quote-unquote with house money." And Brian responded, "Nice, have you been pretty successful with this process?" To understand the meaning of success, I researched my returns under my direct control compared to the S&P 500. I also calculated my win rate and gain to loss ratio for comparison to typical benchmarks. These metrics cover the time period from January 1st, 2021 through May 14th, 2025. I will share my findings shortly so you can decide if my approach to portfolio risk management might be worth pursuing more in depth. I promised Brian to share my approach along with examples of successes and failures. These examples are from the real estate sector, the industrial sector, the technology sector, the consumer staples sector, and the utility sector. The failures are a direct result of ignoring either a fundamental issue that surfaced with the company or not following the technicals. Basically, not getting out of a position soon enough with a smaller loss. This approach may not be for everyone for at least 4 different reasons that I could think of. Where you are in your investment journey. Maybe you're not managing your own portfolio. But I have listened to several professional portfolio managers that use similar techniques for their own or client portfolios. So if you're paying someone else to manage your portfolio, this might give you some insight or a glimpse into some of what those portfolio managers are actually doing for you. Another reason it might not be applicable is the subscription cost of a suitable charting platform. And finally, the time invested to review and update and make decisions based on the charts. And before we go any further and you decide whether this approach might be workable for you, as far as measuring success, I did some research on some key success metrics. And what I found is the win rate. The typical win rate that I was able to locate is anywhere between 40 to 70%, depending on the style of trading that a particular investor pursues. I'm actually sitting at a 78% win rate for what I would call positional trading. For the gain to loss ratio, for the gain side, it ranges anywhere from 1.5 to 3. And for the loss side, it's 1. So a successful trader would be considered anyone that would hit within this range. So basically, it's a $1.50 gain for every dollar lost, or a $3 gain for every dollar lost. On my trades since January 1st, 2021 through May 14th, 2025, I'm actually sitting at a gain to loss ratio of 5.6 to 1. So for every dollar that I've lost in a trade, I've made $5.6 in total for my other trades. And then finally, total return for the S&P 500 over the time span that I mentioned has been 50 to 60%, which is a compounded annual growth rate of 10 to 12%. And my personal total return has been 78% over that same time frame, or 14.35% compounded annual growth rate. Also found some research that said studies like those from the Security and Exchange Commission or individual brokers show most retail traders struggling to achieve consistent profitability, with only about 10 to 20% succeeding long term, and that's basically due to emotional decision making or poor risk management. Says that only 10 to 20% of retail traders are consistently profitable, with most achieving less than 5% annual returns or losses. And when I did the research, it told me that my annualized returns and gain to loss ratio actually placed me in the top 10 to 20% of retail traders, and it could even be higher given the high reward to risk ratio that was calculated. So I'm putting these out there just to show that the techniques that I've employed as far as risk management have been successful for me, and in comparison to what is typical for other traders, has also been successful in comparison. So let's get started. The two examples that I'll provide that fall into the failures category. The first will be MPW, Medical Properties Trust, which is an example from the real estate sector, and also UPS, which is in the industrial sector. In the case of MPW, on October the 10th, 2022, I calculated the intrinsic value of MPW to be $37.29 with the buy price of $18.64, given a 50% margin of safety. My first purchase was on that day, with subsequent purchases for the next 2 months. I reviewed and updated the MPW valuation in February of 2023 with an intrinsic value of $27.71 and a buy price of $13.85 with a 50% margin of safety. For each of my holdings, I track all the transactions using a spreadsheet that I received from a fellow investor and have adopted for my own purposes. But for every purchase and sale, they are entered into this spreadsheet. It shows the date that I bought it, the number of shares, the buy price, the buy total. When I sell it, that goes to 0, and the date of the sale and the sale price get entered with the sale total and the gain or loss on that particular tranche in my holding. So the ones that have zeros, I also color code green just to show that they are closed. The ones that are still in white are open. I'm using Microsoft Excel, so it tracks the price for me live, so you may see this sheet or others that I show change while the video's in play. But on the day that I'm recording this, May 14th, the price at the current moment is 4.93. So it's keeping track of those gains and losses in near real time. So you can see the total number of shares that I have purchased of this company, the amount that I currently hold, the buy total, and the value of the position that I hold today. We can see the gain or loss. In this case, it is a loss of minus 12.2%. I have received dividends of $1,389, which is 8.1%. I have traded some options at a current loss of $22, so that is minus 0.1%. And then finally at the bottom, my total return. So down here I can summarize this as my total buys, my total sales, and the price, average price of my buys and the average price of my sells. We can see here my net investment, which is just the difference between these two numbers, and my calculated price per share. My adjusted net investment is this value, the net investment, minus any dividends, option income that I've received. So my adjusted net investment is $3,200 on this one, which is a share price of $6.41. I have sold some of these, as you can see here. They are marked in green and they have a 0. So those were sold at a loss. So my realized gain is negative $1,867. My unrealized gain on the holdings that I currently have is down $238 or 5.2%. And I have received dividends, option income, so my total return is minus $738 or 16.1%, which is 10.6% annualized. So I won't explain these sheets moving forward. We'll just look straight at the numbers, but this gives you an idea of how I keep track of these and how I'm measuring performance. When I originally bought the original 500 shares in this area, I actually closed them out in March of 2023 at a profit. In retrospect, that is where I should have stopped, but I continued to trade the position through 2023 and 2024. So now I hold just a small position, but it is carrying a loss. In this particular case, I was aware of the MPW struggles with some of their tenants, but failed to truly appreciate the magnitude of the effect on MPW price. I trimmed, but did not exit the position. This is a loss that I am still managing today. The position is improving, but holding the company far longer than I should have has created a loss of opportunities with potential other holdings. Another position I put in the failure or loss column is that of UPS. In October of 2022, I had calculated the UPS intrinsic value to be $215.87, and that was following a year of 47% year-over-year earnings growth during the shipping boom of the pandemic. So I was buying in this range and then failed to honor my stop losses and ended up taking a loss, but still above my average cost per share. We did get a little revival in the pricing, but since that time, it has been just 2.5 years of steady declines. So if we look at my tracking spreadsheet, you can see I entered in October of 2022. It was a small purchase, and over the next couple of months added to that position. And then in 2023, as the prices started coming down, I did what I should not have done, which is try to average down instead of just cutting my losses. So I ended up with a total of 105 shares. None of them have been sold. All of those tranches are in a losing position to the tune of 31.5% loss. I have received dividend income of $970 and some option income at $434, 2.8%. So my average cost is $145.42. I haven't sold any, so my net investment is the same. My adjusted net investment, which takes into consideration dividends and option, drops my price to $132.03. So I still have a loss from that net investment of 24% to the current price. Haven't realized any returns. My unrealized loss is 31.5%. So my total profit, including dividends, options, is down 22.3%. And over the time period that I've held this, which is 462 net weighted days, my total profit annualized is 17.6 per year. So this is definitely going into the loss column, basically because I did not honor my stop loss when there would be an earnings decline over the next 2 or 3 years projected after the pandemic surge. Having covered a couple of losses, I'll switch gears to look at some successes or wins. These wins are a sample representing various sectors. Fortunately for me, the wins have outweighed the losses by a pretty significant margin. For me, the wins sit at 78%, while my losses sit at 22%. AbbVie was one of the first stocks that I purchased in December of 2020 after I retired and converted my company 401k to an IRA at E-Trade and began to manage my own portfolio. So AbbVie is really a purchase I made before I started using the valuation and stop losses as part of the risk management that I use today, that I really started using in earnest in 2022. When I entered AbbVie, it was trading below its intrinsic value. I entered, these are adjusted prices, but my entry price was around $100. And since that time, we can see a pretty steady increase in the price to where it sits today at about 177 or so at the close yesterday. One of the things that you'll notice is that AbbVie prices can go up and down based on the whims of the market or the news in the media about the stock. So this one has lent itself very well to owning a core position and then entering and exiting using stop losses to take advantage of these price swings. So basically the $100 that I invested back here today would be at about $177. I'll show you here in just a moment the spreadsheet that I use to track this, where I have far exceeded a buy and hold approach in this case. If we look at fast graphs back in November, December of 2020, they were trading below the calculated fair value, which is this orange line here. So it was trading well below its intrinsic value and hasn't really reached that until December of 2023. And now it typically trades above its fair value slightly. When we look at the analysis of my trades with AbbVie, I did enter the trade on Christmas Eve of 2020 with a small purchase, and I have traded this many times, as you can see, where I've moved out of the position. All of these have been at a gain. The ones that are in white I still hold, and in 2024 I actually sold a couple at a loss, but the majority of these have been at a gain. So I use that cyclicality in prices to exit out and re-enter AbbVie many times over the last 5 years. So I have purchased a total of 1,218 shares over those 5 years, and I spent $160,000 doing that. I currently have 200 shares. That's my core position and the allocation that I want to have within my portfolio. So my cost at this point is $29,000 for those 200 shares. I have a gain of about 20.6% on those shares. I have received dividends of $6,500 over the 5 years, which represents about 4.1% of my return. And I have done some options and a very small return on that. So if we look at the summary, you can see that I've purchased a total of $160,000 worth of shares at an average price of $132.09. I've sold $158,000 at an average price of $155. So my net investment is only $2,400 or $11 a share. My current investment is at the $147 price. My adjusted net investment is actually negative. So I have a realized return of $27,000 or about 1,100%. My unrealized return is 247%. The dividends I've received on my current holdings is my actual net earnings. My net investment is 274%. Options are 3.4%. So my total return is nearly 1,700% on this. So definitely more than I would have made if I had just bought the shares and held them for 5 years, taking advantage of the cyclicality, entering, exiting as appropriate based on the chart technicals has really led to a significant increase. And at this point, I'm playing with house money. I've made more on this than I have invested. So my total annualized return on this one is about 850%. As with AbbVie, Apple was one of the first stocks that I purchased in December of 2020, basically because I'm a long-term user of Apple products. I did decide to close out my position on January the 3rd when it hit my stop loss. I sold at 5.92% off the all-time high about a week earlier. But as of this recording, Apple is down 18.1%, 0.2% off that all-time high. So I saved myself about a 15% loss on those shares. Looking at fast graphs, we can see that Apple has traded at a premium above its fair value price since about 2018, trading significantly above its fair value now, and the market multiple that's usually applied to this stock, it's trading even above that. So at some point in the future, I may consider re-entering this if it gets down closer to its normal PE. I think the fair value might be a challenge, but the normal PE could come into play at some point in the future. If we look at the Apple share transaction spreadsheet, you can see I've traded this many times over the last 5 years, selling most at a gain. There were a few tranches that I sold at a loss, and I finally did close out my final position. For Apple, the total buys were approximately $94,000 for 690 shares was the maximum. I've sold those shares for 111,000, so my net investment is negative about $18,000. Adjusted for dividends and option losses, I'm currently sitting at an adjusted net investment of minus 16,000. So at the current price today, I could buy 75 shares and still break even. It'd basically be at no cost. In theory, to me, it'd be house money. I'm a longtime member of Costco since about 1992 or so. Costco is not typically a company I would hold, as it does provide the possibility of capital appreciation, but it does not provide much income with a starting yield of 0.47%. However, I've heard many people state they would love to own Costco, but was waiting for a much better price to enter. Unfortunately, the market trades Costco at a premium, so the probability of picking up Costco at their desired price was a little unlikely. We can see fast graphs here where the orange line is the fair value, and over the last 13 years, they have never traded at their fair value. They've always traded at a premium. I did exchange some emails on how to use risk management techniques if they wanted to buy in, and the risk management techniques could limit their potential losses if they truly wanted to own a portion of this company. To help support my approach, I entered at near all-time highs in December of 2022. But what I did notice is that Costco was basically breaking out of a consolidation range at a triple top. So once it broke above this range, I decided to start a position and using stop losses to minimize any potential losses if the trade turned against me. Fortunately, it has not. It's actually traded really well and has almost doubled in price since the time that I purchased it. So when I had my core position, there are some opportunities, as you can see here, where the volatility allows someone to use technical analysis to exit and re-enter Costco at strategic points to help improve the returns over a simple buy and hold strategy. So once again, looking at the Excel spreadsheet for an analysis of the transactions that I've made. I've owned this since December of 2023. I've purchased a total of 29 shares at an average cost of $753 for a total buy of $21,000. And I've sold about 14 of those total 29, so I still hold 15 shares. So my total buys have been nearly $22,753.51 a share. My sells have been a total of $11,900 at $850.98 per share. So my net investment is $9,900, $662 per share. I have received dividends of $243. So taking those off my net investment gives me the adjusted net investment of $9,600 or $646 per share. I've realized a profit of $1,300 or 13% of my net investment. My unrealized profit is sitting at 38%. Dividends have kicked in 2.5% for a total profit of 53.5%. I've held it about a year, so my annualized total profit or total return is nearly similar at 55%. Entergy is our electricity provider. I entered Entergy 1 month after purchasing our home in Arkansas in May of 2021 following our retirement. Since that time, Entergy dividends have completely covered our electricity expenses along with a 222% annualized return. So I first entered into Entergy about right here, pretty much traded sideways for 2 years, but it was providing the dividend income. And then with the AI data center excitement over the last year and a half, Entergy has really shot up in price and has been consolidating here for the last couple of months. My current stop loss for trimming is set at about $83, which it is trading a bit under that at the moment, but I have already done some trimming in the past, so I didn't feel the need to exit any more of this position. I have 2 additional stop losses set here that if something drastic happened and the price really started falling, I would get more aggressive with exiting. Taking a look at the share transaction analysis, you can see where I've made my purchases and made quite a few sells over time, most of them with a gain, a couple I see here with a loss. I still hold quite a few shares. I hold 600. I've purchased as many as 2,300 over time. My total buys have been $118,000 at $51.61 per share on average. My total sales are $108,000 or $63 per share on average. So my net investment is $10,000 or $17 per share, representing a 371% gain over my per share net investment price. My current investment is $29,000 at $48 per share. My adjusted, after taking into account dividends and options, is $2,900 is my money that's invested. That's a $4.84 per share. My realized returns have been $18,000 or $11 per share, 180% gain. My unrealized return still sits at 20,000 for 191%. My dividends have kicked in $8,000, and like I said, it's paid for all of my electricity costs over the last 5 years. So that's 76.1% of my net investment. So my total return has been $46,000 or 442%. I've held this for 715 average weighted market days. So annualized, that's 225% over the time period that I've held it. Similar to Costco, I entered NVIDIA to demonstrate risk management techniques to manage positions for profitability while minimizing downside risk. NVIDIA is a fundamentally sound company with high volatility because of the cyclical nature of the business. I first entered in NVIDIA in November of 2023 at near all-time highs. When it broke above this consolidation range is when I started adding in earnest, and then it consolidated again with another run higher, and then drifting off as the AI trade was diminishing somewhat. Changing to a 6-month view, you can see where I have my stop losses set. I have 3 of them set. During March and April, we did get way below those stop losses, and I did do some trading and trimming as we moved into this, but I went ahead and held them through this time because I believe that NVIDIA is going to do well into the future. And my average cost sits at about $87. So I was willing to risk some of these losses past my stop losses just because my average cost was pretty low. On April 7th, at the market low after the tariff announcements, we did get really, really close to my average cost. And my net cost is slightly lower than that. So it was risky, but I think it was well worth the risk. Since that time, we've recovered a high percentage of the loss that we had during this time. Finally, we'll just take a look at the share transaction analysis. You can see that I've held some of the shares since the very beginning in November of 2023. Others I've traded in and out of, some for gains, a few for losses. But my total buys have been 28,000 at a per share price of $92.90. My total sells have been 16,500 at an average cost of $99.88. So my net investment is $12,000 for the 145 shares that I own. My current investment is $12,578, $86 per share. My adjusted net investment is $12,100. That takes into account the dividends and options. My realized return on the shares that I've sold has not been very much, only a 2.1%, but my unrealized return is 6,700 at the moment, or 54.4%. NVIDIA's dividend income is incredibly low, and that's one of the reasons I wouldn't typically hold a stock like this. But I was working with some other investors to show that you could use risk management techniques to enter a stock that was trading at all-time highs if the technicals were supporting a purchase at that point and use risk management to minimize any losses if the trade turned against you. So my total return has been a little over $7,000, 57.6% total return. I've held it for less than a year on a net market weighted days. So my total annualized return is 77.8%. I have revised my approach to stop losses about 3 times in the last 5 years. I began with using stop losses directly in my trading platform, but I discovered that I was getting stopped out in some cases based solely on price without first understanding the fundamental reason for a stock price change. Additionally, I found to my dismay that market gap downs at the open would often stop me out, and then I would find that the price would recover throughout the day. Secondly, I used charts to set a stop loss at a certain percentage below current trading price. However, using percentages didn't necessarily account for the different volatility profiles between various companies. Thirdly, I moved to using Chandelier Exits to set the stop loss price. Chandelier Exits uses the average true range of the stock price over the last 22 days by default. This helps to account for volatility. And then I use a multiplier to establish 3 levels. The first level is where I consider trimming anywhere from 10 to 20% of my holding. The second stop loss is where I consider trimming my position by 50%. And third, where I consider closing the position. These are somewhat arbitrary levels and can be adjusted to suit your own personal preferences. Let's look at the high-level overview of Chandelier Exits in the StockCharts school. Then I will show you how I set them up in the charting platform. I will place a link to the Chandelier Exits article in the video description if you want to review in more detail. So the Chandelier Exit is an indicator that can be used to set trailing stop losses for both long and short positions. I currently only use them for long positions. It was developed by Charles LeBeau, and it sets a trailing stop loss based on the average true range. The indicator is designed to keep traders in a trend and prevent an early exit as long as the trend extends. And that's really important. It tends to keep me in trades longer than I might otherwise stay in a trade because the Chandelier Exit tells me when to exit so I don't exit out when I've reached a certain percentage of a gain. It's often the case that when you get a run in a price, you start looking at the profits you could capture and exit out. But by staying in a trade a little longer, you can boost that gain percentage even higher. They go through the calculation for how the Chandelier Exit is calculated. I'm not going to go through that today, but you can go to the article and read it later if you wish. The Chandelier Exit is basically a volatility-based system, and that's where it had an advantage over just setting a certain percentage, because the volatility of a stock wasn't necessarily taken into account. So this accounts for that. So we'll look at a Chandelier uptrend, which is basically what I use it for. So sometimes chartists will see a strong uptrend, but not know where to jump on and when to exit. And that's really important. The Chandelier Exit really helps me to establish when I should truly exit a position or trim a position. So you can actually see in this example chart where Eaton Group in 2012 broke out of a pattern and started rising and went on a run from about $50 a share to $63 a share. If you don't have a strategy in place to determine when to help you exit, it'd be quite possible that you would maybe exit here because you start seeing the price go down, but it hasn't actually hit a stop loss yet. And in this particular case, it jumped back up and continued on its run. It wasn't until it broke through here or here that it would drop below the Chandelier exit and then tell you that it's probably a good time to start trimming or exiting the position. So here's the bottom line. The Chandelier exit is mostly used as a trailing stop loss during a trend. Trends sometimes can extend further than we anticipate, and the Chandelier exit can help traders ride the trend a little longer. So that's it for a quick overview and why Chandelier exits are so useful. In the StockCharts school article, we saw a Chandelier exit example using Eaton. AT&T is an example from my own portfolio using Chandelier exits. I've been an AT&T customer for about 25 years. I also worked in the industry for many years, so I have a fairly good understanding of the industry. To say the least, investor sentiment is not very positive for AT&T for a few reasons. The fact that AT&T carries a high debt load, much like other telecommunication companies. AT&T management making some bad acquisition decisions along with cutting the dividend keeps many investors away from AT&T. On this chart, I've modified it to highlight the price as a 5-day simple moving average, which is the purple line, along with the Chandelier exit, which is the orange line. I use that as an indicator to do trimming when necessary. The two Chandelier exit lines that are highlighted in red, they're a little fainter than this orange line because I don't want to focus on them so much. But that's where I would do deeper cuts or even consider exiting the position completely. The green horizontal line is my average cost per share for the shares I currently hold. Over the last year, AT&T has risen about 60%. I might have been tempted to trim early with 10 or 20% gain. However, the Chandelier exits kept me in the trade all the way to March of 2025, where I trimmed for a 52% gain. So if you look at the price of AT&T and the Chandelier exit that's running right underneath it, that's what kept me in this trade, because the price was staying above that Chandelier exit all the way up until just about the time they reported first quarter earnings, where they gapped up and once again stayed above the Chandelier exits all the way until basically all the way to the middle of April. On April 3rd, the Chandelier exit peaked on all three Chandelier exits that I have indicated here, and that's where I set my lines as a high watermark. So I'll continue to watch the price in comparison to that particular point. This was basically from a risk management position allocation perspective. Because the price had run up 60%, the position had grown to be too large of a percentage of my overall portfolio. So that's what basically led me to do some trimming there and to reduce my risk. In addition to that, We can also see that the price was running up, but we see a negative divergence in the RSI, and we also see a negative divergence with the MACD. This is usually somewhat of a bearish signal. That was another reason that I decided to trim. Over the last year, my orange line, which is set to the peak value of the Chandelier Exits, was constantly adjusted up as we moved through this past year until it currently sits where it is at the April 3rd. If I had bought and simply held my shares, I would have approximately a 70% total return of my holdings, which would exceed that of the S&P 500 at 61%. This chart highlights AT&T compared to the S&P 500, along with Verizon and T-Mobile. T-Mobile would have provided a better total return over this holding period, but since I'm not a customer, I would not have had the same level of commitment necessarily as I have toward T. So for me personally, as a customer, it made more sense for me to hold T. Analysis of my particular trades. My total return is actually sitting at 121.1%, and that is 53.2% annualized for my holding period. So you compare that to the buy and hold strategy of 70%, and I've outperformed that by about 50% for AT&T using this risk management technique. I recently added Google to my portfolio. I will show you how I set up my chart after opening this position. Before doing so, I'll explain why I entered Google at this time. Google is facing headwind risk, including regulatory scrutiny and concerns about their search dominance with the introduction of AI search. Google is currently trading at 17.48 times. That's about 30% below its 5-year average of 26.48, but above the sector average of 12.59. However, they are expected to grow their EPS and revenue at a significantly faster pace than the sector. Google is expected to grow over the forward year 20.57% compared to the sector at 11.22%. Revenue growth over the next year is expected to be 11.67% for Google compared to the sector of 2.93%. And then when we look at their profitability, they're more profitable than the sector, with Google having a net margin of 30.86% compared to the sector at 3.76%. And if we look at fast graphs, we can see that Google has traded at a premium for most of the last 13 years or so. The fair value is the orange line, but they've traded at a market multiple that is much higher than that. There was a drop in 2021 and 2022 where it came down to pretty close to fair value. We got to this year, and there was a lot of talk about Google being threatened by the search business, where many users, especially younger users, are not using Google search. They're going straight to some AI tool to do their searches. So this puts some pressure on Alphabet to address how they're going to improve their search to meet the needs of these users. And as such, there's been some headwinds that have driven the price back down to fair value as calculated by fast graphs. So they're currently trading at a blended PE of 19.41. They have a fair value of 18.43 times, and their normal is 24 times. So they're trading about 5 times, 6 times below where they normally trade. I also notice on the 5-year weekly chart, if I draw a horizontal line across here from the peak in 2021, I can see that it has tested this line on 4 different occasions. One is a resistance line here. It dropped in 2022 like other stocks during that year. It came back up to test that resistance line and then broke out above it, and it came back down and tested it as a support line. Bounced off, came back down, tested it once more, and now looks to be rising. So all of these indicators to me, all of this analysis that I've done, just tells me it's probably a good risk to reward to enter Google at this time. So let's go set up the chart. I initiated my position on May 9th at 155.15. That is indicated by the green line, so I can keep track of my average cost per share. The Chandelier Exit for that particular day was sitting at 151.56. So that is where my orange line got set. And I also set my second level exit point to the Chandelier Exit for that particular day. On May the 16th, I did increase my position by about 50% at a cost of 167.82 per share. So my average cost per share is now 159.37. So when I'm reviewing my charts after purchases or my daily review, I can just go and update this. So my average cost is now 159.37. So that green line is moved up. And then I can also see that the Chandelier exits on both of these two exit points have also increased. So I can just look over here to the Chandelier Exit for the first exit point, and that price is 154.09. So I just go down and change my orange line, 154.09, to match that new Chandelier Exit level. And I'll do the same for my second level exit point, which is currently sitting at 143.05. The third level exit point is not visible on this chart at the moment. So now when I save this, you can see that my exit line has moved up on these two exit points. And we do have a 5-day that's increasing. Google is riding up that line. Google's RSI is improving. We did have a MACD crossover with the momentum above the midpoint of 0. So that's showing good positive momentum. So it looks like I'm in a good position for this trade at the moment to ride this, what I believe is to be increasing prices. So basically my cost sits here. I'm willing to lose up to this much below my average price. If for some reason my decision is incorrect and the price falls down below this line, then I'll exit the position and reevaluate. So I'll continue to watch this over time and see how the trade progresses, and using these risk management techniques is how I will ensure for my personal use, that I don't hang on to a position if it turns into a losing holding. I know this was a long video, but I believe applying risk management techniques to my portfolio and my individual positions to be of such great importance that I wanted to make sure to cover in enough detail for anyone else wishing to apply similar techniques for their own use. I hope this was beneficial to you. If you found value in the video, please consider subscribing to the channel and also like the video. Doing so helps support the channel. I wish you success in your investment journey, and remember to trade well.